hopefully the mic works. Okay, good afternoon, and thanks for being here. Ladies and gentlemen, Mesdames les ministres, Monsieur le Gouverneur, and a warm welcome to all of you. It is a true honor to stand before such a distinguished group of institutional investors, financial leaders, and corporate decision makers. And on behalf of Santander France, I want to express my deepest gratitude for your presence today at our annual conference here in Paris. So this gathering is not just a meeting, it is a testament to our shared commitment to shaping the future of Europe's economy, defense, and financial resilience. And today we have the privilege of engaging with Philippe Lane, who, as you know, is the chief economist of the European Central Bank, and whose insight will undoubtedly illuminate the path forward for our continent's economic challenges. Later, our multi-European panel will explore how we can accelerate and strengthen Europe's defense capabilities, a topic that, as you know, has never been more urgent or more vital. At Santander, we believe in the power of collaboration. So we're here to listen, to learn, and to serve as your trusted partner in navigating the complexities of today's financial and geopolitical landscape. Whether it's supporting your investment strategies, facilitating cross-border opportunities, or fostering innovation, we are at your service. And as the head of Santander France, I am personally committed to working alongside each of you to drive growth, stability, and shared success. Don't worry, I won't be long. This is nearly the end. The road ahead is filled with both challenges and opportunities, but we all believe that with leaders like you in the room, visionaries who understand the importance of bold action and strategic foresight, I'm confident that together we can turn these challenges into milestones. So let's make today a day of meaningful dialogue, actionable insight, and strengthened partnership. And once again, thank you for being here. Let me introduce, also you don't need it, but I still have to do it, Professor Lane, who is ECB board member and chief economist. He's responsible for the bank's macroeconomic analysis, monetary policy preparation, and economic research. As such, he's obviously playing a central role in guiding Europe's policy response through periods of uncertainty and transformation. And prior to joining the ECB in 2019, Philippe, you served as governor of the Central Bank of Ireland, and before that, you enjoyed a distinguished academic career as professor of economics at Trinity College Dublin, where your research on international macroeconomics, capital flows, and European monetary integration earned global recognition. I think you're also the first central bank governor who have launched a blog in the middle of a crisis, as you were saying earlier. So we are very honored to have you with us today, and please join me in welcoming Philippe to this meeting.
So thank you, Laurence, for the warm welcome. Maybe at this time of the year, we're coming to the end of 2025. And so maybe I'll begin with just some remarks about what a year this has been. So if I go back to last December and the staff projections for this year, the ECB staff projection for this year in December was 1.1. In March, there was a downgrade to 0.9. In June, that downgrade was maintained to 0.9. But then in September, in the scheme of going, 3 months later for the same calendar year, there was an upgrade to 1.2. And then more recently, not our number, but the Commission's number is up to 1.3. So if you can say, well, that's a pretty static view. There's all this drama, but in the end, now I think the timing of those slight revisions makes sense. But in the end, the overall narrative, when the history books are written, will be that the European economy probably grew somewhere close to potential. And maybe that is kind of a fairly balanced position for the European economy. Let me say, of course, within that overall view, there has been a clear rotation. Clearly, the export sector has faced many challenges, not just from the trade policy situation, but there is a structural shift in the world economy going on, which is definitely affecting the European economy. But maybe there's been a counterbalance from the domestic sector. There's a counterbalance from consumption to some extent. There's a counterbalance from business investment in a very particular sense, because it's basically business investment in AI-related activity. It's not business investment in traditional machinery and equipment. And then there's a significant contribution from the government sector. Both public consumption and public investment has been strong this year. Let me also say, of course, compared to the worst fears in quarter two, the tariff situation has been less severe than originally feared. The level of uncertainty has come down, and of course the US economy has been fairly robust, both because of the AI dimension and the fiscal support. Let me also say that when we think about the export sector, it's this two-sided squeeze. It's the squeeze from the tariffs vis-a-vis the US, but it's also the squeeze from the rise of China as a greater rival in export markets for European firms. So if I turn to inflation, inflation has been around the 2% target. But let me emphasize is that overall number is a bit flattering, because what we have is non-energy inflation at 2.5% and energy deflation. So after the really big jump in the energy price level during the pandemic and the first year of the Russian-Ukraine war, there has been some mean reversion in energy prices, very minor, but it is creating a deflation process right now. So for sustainability of inflation at 2%, we do need to see more deceleration in non-energy inflation. We're confident that's going to happen because everything we look at tells us wage dynamics are set to decelerate further. Maybe for those of you who are specialists, maybe you look at what we do, but one of the innovations in recent years at the ECB is what we call the wage tracker. So thanks to the fact that we have all the national central banks, we can keep track of the universe of wage contracts across Europe. And so already we know a lot about 2026 wages, because a lot of unions and employers have signed contracts across Europe. And those built-in contracts have further wage deceleration next year. And our surveys also have it. So if you like, where we are now with inflation is we have the economy growing, unemployment at a historic low. On the other hand, we have this wage deceleration, we have the appreciation of the euro, we have the drop in oil and gas prices, and we have the deflationary effect of Chinese exporting firms lowering their prices. And this is why the overall trend in inflation being around target remains a push and pull between those different factors. And maybe we'll come back to some of those topics as we move along in the discussion.
Absolutely. Thanks a lot for setting up the stage. Philippe set up a very serene view of our global economic landscape, which is quite disturbing because it's all being about political uncertainties, geopolitical uncertainties, fiscal uncertainties in many of the European countries and also in the US. We have and you've addressed it many times, tariffs on top of this, and we also have, and you were at the IMF meeting together with Antonio as well, and a number of people in this room, the uncertainty created by stable coins and the demand for US treasuries that this is going to create. So you've been describing something that is steadily growing and quite reassuring, and at the same time, we are seeing pile and pile of possible economic shocks to our economy. So I guess the easiest question to ask you is which of this uncertainty is keeping you awake at night? And I'm very curious, and you've mentioned it in earlier interviews, to hear how you rank the uncertainty created by the introduction of stablecoins, its effect on US Treasury demand and possibly exchange rate that in turn would affect your inflation views.
So when I agreed to participate in this event, I hadn't quite realized it's going to be the same day as we published our financial stability report. So this morning, I gave you our baseline view in what I just said. But of course, we also study tail risk. And the financial stability review came out this morning. I encourage you, if you haven't already, to look at it. And it's a mix of kind of a template. You know, it gives you a world tour of all of the different elements of the financial system. But there are special studies. And the special studies look at these more novel questions that you did raise. So, I mean, you're asking specifically about stablecoins. So let me say that, first of all, we have to put this into context. And I don't know, all of you in your different roles have to locate the stablecoin debate in the wider debate about essentially the tokenization of the financial system. So that's a spectrum. And, you know, I think, and I'm not sure where Santander is in terms of the tokenization of bank deposits. Then you have the tokenization of bonds, the tokenization of collateral. And so in that grand scheme, part of that is the stablecoin issue. But you might say stablecoins are very special in their property. Purchasers receive zero remuneration. That's a super exciting investment opportunity, to receive zero remuneration. I read some number the last 24 hours about Tether's profits this year. You know, if I'm a stablecoin intermediary, it looks like great business for now. Pay zero to your customers, earn whatever you can pick up on treasuries. I think it was FTT, Tether, and gold. They're huge gold holdings. So what I would say is this does not sound the most exciting financial innovation that ever happened. But we have to keep an open mind about some potential use cases. And I think I saw Klarna or someone today announce a possible role in their corporate payments system. So having made the point maybe that let's take a broad view of this, that the whole tokenization issue looks like a real technological improvement. If you can tokenize assets, it should reduce settlement times. It should mean a more frictionless financial system. The stablecoin first wave of applications does not seem the most exciting. Now, having said that, it clearly does mean access to dollars has gone up if you are someone living around the world. If you're a European, there's no problem. You can buy a dollar money market fund, you can buy a dollar bond fund, and so I don't expect people in the euro area to be buying dollar stable coins for an investment purpose. But if I'm in some troubled country, it's an easy safety valve to have. Then you go to the value of the dollar, the demand for treasuries. Stable coins, because they need to maintain par, are super short term in their maturity structure. Their holdings of treasuries are at the very short end. So then the question is, of course, that's interesting if I'm managing the US debt. So it's not a uniform demand across the maturity spectrum. It's an increase in demand at the very short end. So, of course, how much debt you want to issue at the very short end with rollover risk is something the US will have to consider. And for sort of the same reason, I'm not so sure it's going to have a massive exchange rate effect, because it's a very specific, very narrow slice of the whole market.
Okay, thanks. I think Antonio.
Yes, thanks, Philip. If we can go back for a second to the scenario that you described before on growth and inflation, it seems that on the growth side, the news have been sort of more one-sided, more positive. You've been upgrading your forecast, and there was even some positive surprises since the last meeting, the last Governing Council meeting. On the inflation side, things a little bit more two-sided, and perhaps I would argue a little bit more to the downside. So I want to ask you precisely on this. There's an upside risks that I see them perhaps as longer term. Some of the fiscal impetus coming through defense expenditure, coming through infrastructure. The German plan is a good example. But then there are some downside risks, which I think are bigger in terms of impact, and they're more imminent, something that is happening already, which is related to the issues that you're mentioning about exports from China, this trade diversion, that China is exporting less to the US and exporting more to the rest of the world, including Europe, and competing with us. Weaker import prices, and you had a very nice blog where you actually discussed these issues, and the euro, right? And this is something that is ongoing. This is something that is already impacting the prices. So I kind of see the balance of risk a little more to the downside, at least on the near term, and the impact being larger to the upside. What are if you can kind of deepen into these issues, what is your assessment and your views on that?
So, what we do have in the September projections, which are our most recent projections, is that there would be next year below target inflation. So it's already in the baseline of having a phase of below target inflation. As you say, it's energy deflation. This year I just looked at my, I get a daily email about where all the market prices are. And from the point of view of the energy markets, from over the course of this year, the price of oil has fallen 13%, the price of gas has fallen 34%. This is a big energy negative shock. From a European point of view, that reduces the price level. From a terms of trade point of view, since we import so much oil and gas, it's also positive, for the wealth, the wealth effect channel for Europeans. So, the issue is, Antonio, I think, compared to that baseline, which assumes a significant effect of euro appreciation. It assumes, because the China issue has not just emerged now, it's already been handled in September and previous projections. So there's always going to be two levels to this. One is, as the staff are working day by day on the December projections, is does that baseline view need to change? Mm-hmm. And then compared to that is, as you say, the evolution of the risks. So again, for those of you who don't follow us necessarily every day, one project over the last year, which finished midsummer, was a strategy review of how we do monetary policy. And one of the main messages out of that strategy review was to add greater weight to the risk distribution. So the baseline is actually never more important than under uncertainty. The world really wants to know what's the most likely path. But we also have to think carefully about that risk distribution. And so, and I'd be a very strong advocate of that, is let's be humble about trying to grade upside and downside risks. You have to do it as an investor. I don't have to do it as a monetary policymaker, because we will change our mind every 6 weeks. So would try to be fairly emphatic about saying we're looking at everything. We're looking at every risk. I'm not, and essentially a lot of these risks, as you said at the start with geopolitics, a lot of these risks are not something that repeatedly show up in the historical distribution. So trying to estimate what is the, where are we in the probability distribution is really difficult. So what we do in our monetary policy statement is we list the risk factors. So we're looking at the China deflation issue, we're looking at currency appreciation. Currency appreciation has been here forever, and all energy prices have been here forever. So we do publish on that lots of what-if scenarios. So you can keep track. If the currency moves by X, what's the likely effect on our projections? If oil prices move, what is the likely effect? But when you get to tariffs, okay, if I go back 100 years, I can look at the data. But we really do have to be data dependent, meeting by meeting on that. So what I would say is the baseline does have this phase of below target inflation. And in that sense, there's clearly a downside orientation for now. And what I would say is, in relation to the upside risks, we obviously have a very big upside realization in 21, 22, where inflation went to 10%. But that was so unusual in its origins between the pandemic and the war that it's very difficult to see that kind of massive upside risk being realized. So the upside risks I would say that we're focusing on is, number one, a faster recovery in the European economy. We do have to allow for that. But as I say, right now we're not seeing a super strong European economy. And then number two is, so that's a demand-led inflation, faster recovery, stronger labour market, all of that. The other scenario would be some unexpected deterioration in the trading environment, which we've seen various countries approach danger lines, for example, danger lines that might lead to loss of access to certain resources from China. But if those danger lines were crossed, then the scenario where the world economy would be kind of plagued by bottleneck factors could come back. But let me emphasize, in that scenario, you could get inflation jumping. We'd have a major hit to the economy. And that scenario, a very negative supply shock, is clearly different in its implications than a European economy growing more quickly, the AI kind of global boom prompting investment globally and so on. That's much more of a kind of benign demand side inflation.
Just a quick follow-up. I mean, the ECB is a single mandate on price, not double mandate like the ECB, like the Fed also looks at the labor market. But the labor market is important, as has a lot to say about wages, and wages have direct implication for services inflation, which has been quite sticky, not just in the euro area, but globally. So maybe if you can dwell a little bit more on that. I remember last time we met in Washington, as Laurent was mentioning, I think kind of you described a labor market that looked a bit like Goldilocks, close to full employment, and yes, wages having been up, but sort of coming down. Can you elaborate a little bit on that? And how do you see services inflation, which is such a big important, behaving going forward?
So again, for those of you who will have learned your economics at a certain point in time, you might, first of all, and I showed a graph at a presentation recently about European unemployment from the late 90s to now. And again, at many points in time, if you had asked someone, okay, what is wage inflation going to look like in Europe when unemployment goes to 6? Yeah. Having been double digit for so long, you might think this will look like a very hot labour market. So why have we got a pretty big deceleration in wages? So I think what we've learned from recent years is the number one factor driving wages has been the cost of living. So inflation went up to 10% in 22. Beyond Belgium, Luxembourg, which have indexed wages, labour market institutions move fairly slowly. They move differently across countries. I mean, I think here in France, there's a lot of 1 year renewal of labour contracts. In Germany, it's 3 years. So it's taken a long time for people, for their wages to recover. But in those years, we did have wages growing at really high numbers compared to historical average. But that has turned. It's turned, and it's turning even more so going into next year. So what I would say is, what I would say is, where we are with the labour market now is our ability to deliver 2% inflation, I think, is credible. To have 2% inflation, we need European wages to be growing at, depending on your view of productivity, let's say 2.5 or 3. That looks like more or less where the wage growth is going next year. That needs to be maintained at that level. So if unemployment is maintained around where it is now, it looks like it's low enough that firms are comfortable agreeing to wage settlements of 2.5 or 3. I doubt that would have been true if unemployment was still 10. The open question is, where does it spill over from being a decent labour market into being a hot labour market? And this is where what's going on in Spain is super interesting, because a lot of the unemployment decrease in Europe has been Spain and Italy, going from really high to lower, but still high. I'll let you offer your own analysis of where is the kink in the Spanish labour market, where it goes from being okay to being a hot labour market. So one issue is you have to think in your area, where is the unemployment falling? Because in Germany it's gone up by a percentage point. In France it's gone up. So when we think about the overall heat in the labour market, that country by country analysis is there. The other big point to make is, you may have noticed, Europe is getting older. A European labour market characterised by 55-year-olds is not the same as a European labour market characterised by 25-year-olds. The credibility of 55-year-olds saying, pay me more or I quit, is not so high. And the people who look closely at labour markets, is that quit option is an important driver of bargaining power. So what I'm saying is we have lower unemployment, but because the demographic mix is different, how much heat it's generating in the wage process is open to question. The staff have done a good job of tracking wage developments, but I'm open-minded about finding a kink at some point where the dynamics could change.
Thank you, Philip.
Yeah, I'm not asking the average age in the room. You might be a bit disagreeable on everyone here. And I will change the topic so that we don't have to insist on this. Obviously, you were mentioning the risk to a rise in demand. The ECB is estimating that the European Union needs about 477 billion for the green transition, 125 billion for artificial intelligence and digital technology, and 800 billion for defense by 2030. So a large part of this may come from the private sector, but the public sector will likely be contributing, and to a significant extent. So I'm very curious to know how much that represents as a fiscal impulse in the modeling that you're doing, and what sort of multiplier you may be expecting from this spending, whether it's AI, defense, or even the green transition.
So obviously the big challenge for Europe, for a lot of countries, is the debt level is high. So how do you reconcile the imperative to have higher public spending? So whether that's on defense, whether it's on growth-enhancing public investment, while also recognizing the demographic trend. It does mean there's a trend in healthcare expenditure, pension expenditure, and so on. And so this is where one reality is before the pandemic, and when I started as chief economist, when you looked at the fiscal balance in the euro area, it was significantly less than 1% deficit in the aggregate. What we have now is 3-something, and forward-looking 3-something seems to be where it's going to be. So not American-style fiscal deficits, but a lot looser than before the pandemic. So there is that level of debt financing, but a lot of this will essentially have to be a balanced budget multiplier, where a lot of this spending, if it's going to happen, it's going to be from reducing other types of spending or by raising taxes. So then balanced budget multipliers are typically positive because essentially if you cut low multiplier activities and increase high multiplier activities, that's going to be net positive. And if you raise taxes, a lot of Europeans are high savers. And essentially, from a macro point of view, obviously, as long as you make sure the taxes are not so high, you kill incentives, then there should be a positive balanced budget multiplier. So I said this year, we do have a noticeable contribution from public consumption and public investment. But the European deficit is not widening this year. It's essentially, if you like, a version of a balanced budget multiplier. So, and more generally, to the extent you think fiscal spending should be heavily orientated to the domestic economy, defining domestic to be your area, again, that should be a higher multiplier activity. So we're going to be tracking, and again, because the euro system works, in collaboration with all the national central banks. So the national central banks will be looking at every procurement agreement, in terms of national defence, in terms of infrastructure, and so where we will end up in multipliers will be very granular, building it from the basically contract by contract what we see. So the issue is, I think, this requires a lot of execution. How do you execute that big rotation in fiscal policy? And the stakes are high. People can, the topic after this one, when we go to defence, I think there's a high commitment to delivering a lot of what's been committed to under defence. There's a recognition that the public sector will have to play its role in the green transition, digital transformation, and so on. But this maybe cross-referencing is why we're also so emphatic about the importance of really moving ahead with Capital Markets Union, because we really need to make it easier to unlock private sector investment in a lot of these categories. So what I would say is, if you go super high level, if you think about the typical fiscal balance in Europe, because of the reality of having to stabilize debt ratios, it does look like probably to me 3-something might be a typical aggregate fiscal deficit. Much higher than before the pandemic, higher than the Maastricht limit, but not kind of growing without bound.
Okay, I might be getting a bit off track there because I'm conscious of the time and we want to leave a time for questions from the audience. So if that's okay with you, I will spare you the question on the French debt. I will pass the floor to your last question, Antonio, and then we can open the discussion with the public.
I think just one very quick question, so we'll let the audience. Since you published today your financial stability report, let me ask you sort of a financial stability question that I get asked many times here when I especially speak with French investors, which is, look, there's been, over the last couple of months, a lot of fiscal uncertainty in France, and that has created bond volatility. And of course, if there will be greater bond volatility, the ECB now has tools to deal with that, which is the TPI. Now, my usual answer to that is that, well, the TPI, kind of my layman understanding of it, since it hasn't been never deployed, probably never will, is that, look, this is only to take care of innocent bystanders, not those that, self-inflicted policy mistakes, right? Take the country you want to take. Is that the right understanding about the TPI, or is this something that could be activated in this type of circumstances?
So I think the TPI, and for some reason, it's not a total surprise that question came up. So I did bring the press release from July 22. And again, for those of you who kind of study bond markets, especially sovereign bond markets, there's always been one distinct scenario, much studied around the world, which is basically this multiple equilibrium problem, which is any individual might be fully confident that a sovereign will be okay, but it's the Keynes beauty contest issue. If you believe the guy next to you is running, you run more quickly, and you can have a collective run for the exit. That is essentially a situation where if the market believes there's going to be order, there will be order. If the market believes there's going to be disorder, there will be disorder. So I think a classic role for a central bank is to rule out unwarranted, disorderly market dynamics that pose a serious threat to the transmission of monetary policy. And I think that's been playing its role. Of course, and this is very deeply embedded in the European Treaty, that is not a kind of invitation to say all bond yields in Europe should be the same. If the bond yields reflect fundamentals, if they reflect orderly dynamics where the market is every day reassessing those fundamentals, that's fully in line with how the euro area has been set up. Mm-hmm. So I think TPI is valuable. It plays a very important role in ruling out unwarranted, disorderly market dynamics. And I think that plays an important role ex ante, that people know I have to worry about a lot of things, but to worry about that panic equilibrium, I don't have to worry about that so much. And it kind of filled a hole in the euro area architecture that had not been spelled out. So I like the TPI as an instrument in completing the architecture. But again, if I'm looking at a European sovereign, if I see orderly dynamics, then I think the TPI is not relevant.
Thank you, Philip.
Thanks. So everyone can find the press release on the website of the ECB, obviously, if you have further questions on this. But I think it's the time that we open the floor to questions from the audience. And there's one here, just in the front on the second row.
Thank you. So, given the relevance of artificial intelligence, apart from defense, in growth, productivity, and definitely CapEx, how do you factor that in as a chief economist, not only in the growth projections, but if you have any estimate on the natural rate of the Eurozone, the famous R star? Will all that CapEx and all this investment affect the natural rate? Because in that case, staying put will actually make you become expansionary, right?
So where we are now is essentially where the dominant issue with AI right now is demand side. As you say, it's building data centers, it's buying the NVIDIA chips and so on. So there's a big demand side push. Many people have been examining the fact that now the tech sector has become capital intensive after being capital light for so long. Further out, if you have a really big increase in productivity, Then in terms of consumption behavior, and I think in the US, consumption already is supported by people's optimism that their portfolio returns, their future incomes will be boosted by AI. On the other hand, when you look at AI, for many people in the labour market, it's a source of fear. So people who are, have enough resources to be participants in being a shareholder and a beneficiary might look at the upside. For many people, they look at it and say, I'm not so sure about my labour market prospects going to the future. And so it's a contest between fear, which is contributing to pretty high savings rates in Europe. So what I would say in a European context, what we have now is we are starting to see more investment, which is on one side of this debate, but we also have savings that is higher than what we expected. And this is why, again, you as investors will have to make a call. We're more reactive in the sense of every 6 weeks we can change our mind about, but that's essentially, I think, for me, the way to track it is what is the investment response, and then what is the consumption/savings response. And we talked about the labour market earlier on. In the grand scheme, low unemployment, good, but vacancies are trending down. There is a significant trend down in vacancies, and if you look at the kind of new college graduates, that is clearly something where there's a lot of, a kind of a shift in the labour demand. So this is why I think it's not just a one-sided debate. That issue about how people think about the future, and it's not just AI, of course, it's also geopolitics, fiscal. So, people trying to work out 10 years from now, what is my tax burden going to be? So there's a lot going on in the savings rate.
Thanks a lot, Philippe. So we have lots of questions, and we can be very selfish about it, Antonio and myself, and continue discussing. But if you have a question, I think there's one in the back, in the middle.
Thank you. You referenced the Financial Stability Report, and you spoke very eloquently on fiscal deficits. I'd say that's the most top-of-mind topic this year for investors. If we look at ECB's government bond buying program, that would effectively have suppressed government yields, opening the doorway to larger fiscal deficits in Europe, and has that, in effect, undermined financial stability in Europe? And is that a situation that at any time can be recovered?
So let me say a couple of things about this. In the pandemic, we obviously did a lot of QE. So the PEP program was created. We stepped up QE. The counterfactual would have been, I think, a lot more pressure on private sector balance sheets. The governments of Europe made pretty big transfers to households. And I would invite you to speculate about the financial stability implications of households under much more financial stress than they are. There's a lot of transfers to corporates. And again, corporate balance sheets are a lot better than you might have feared at the start of the pandemic. And then banks, because the corporates and the households have been in good shape, we've not seen NPL headaches in the banking system. So what we have is a financial stability risk associated with sovereigns, but you have to read that jointly with a lot stronger balance sheets in the private sector. So if the counterfactual, which of course we can never run the counterfactual in real time, but if the counterfactual without QE would have been a more damaged private sector, then the net financial stability risk factor, I think, is open to debate. And let me say, well, before the pandemic, there was a lot of QE. And again, if you think about the recovery from the financial crisis in Europe, the ability of, over a long time period, for many countries to repair themselves after the real estate crisis and so on, again, without QE, I think that would have been a much more difficult problem. So I would say, we and I personally have, I think, a very kind of a multi-sectoral perspective on QE. And I would say in Europe especially, because we do have a fiscal framework, I think, and we see it all the time, there is fiscal discipline on governments. They are, really fearful of spreads and so on. So the idea that this is kind of creating a lot of moral hazard, I don't think so in the European context. I don't rule out, if there were a belief that central banks being open-endedly doing QE. The other thing to note about QE is, and this is why the fact we've stopped, that we're shrinking the balance sheet, is, I think, providing a lot of lessons. One is our QE decision was driven by our price stability mandate. When inflation was too low or the economy was at great risk, doing QE, we did QE. When inflation went above target, we stopped. So there were alternative narratives out there about why we were doing QE, but as more time goes on, stepping in and stepping out, really underlines that it was driven, as Antonio said, we do have a primary mandate. We do have to be able to explain ourselves in terms of that primary mandate. So I think, as we roll forward and the balance sheet shrinks even more, this is, I think, going to be a situation where, not now, but 10 years from now, people looking back can write a more considered, complete narrative about QE and QT.
I actually have one question there.
Hello. Thank you for your comments. In terms of tariffs and recognizing that the impact of tariffs is asymmetric across the US and other countries, but you made the observation that perhaps that the tariff impact had been smaller than some people had expected. And we recently had a speech from Chris Waller that said that companies had absorbed a lot of the impact of the tariffs in the United States, and now we're getting ready to lay people off because their margins had been hurt by the degree that which they had absorbed tariffs. And sometimes we also talk about tariffs being transitory, and therefore it's just a one-time adjustment in the price level. But given that it took so many months of so many different announcements, it's very difficult to know when that 1 year ends. But maybe hearing your thoughts about perhaps why the impact in the US was much smaller than expected, but also sharing some observations in an international perspective would be very interesting to hear.
So what we said in our September statement, which I strongly believe is, it's a bit like the quote about the French, it's too early to tell, that this is something that will play out over several years. So what we have looked at, even because there were tariffs in the first Trump administration, and when you study the effect on the economy, it goes well beyond the first year. And again, as he just said, I mean, some firms could have said, well, for now, I'll absorb it. But at some point, my profit margin goes down too much, and I have to pass it through. So I don't think I would say the effect of tariffs have been smaller than it might have been expected. But what I would say is there's a lot of other things going on. So number one is the US economy has been stronger than expected for reasons independent of tariffs. It includes dollar depreciation. Tariffs were projected to have dollar appreciation. So dollar depreciation has helped the US economy. Passing the fiscal bill near term helps the US economy. Let's see about the long term. And then the AI effect, both directly in the sectors investing, but more generally through the portfolio wealth effect, does mean for a lot of the products going into America, the price sensitivity, at least in some sectors, has not been that low, not that high. So the ability of firms, depending on the sector, to pass prices along has been there. But my basic point here is it's too early to tell. Many sectors, there was inventory accumulation. They haven't had to kind of pass it along. And so I do think going into next year and the year after, the kind of lagged effects of those tariffs will be important. So I think there's also a simple measurement issue. The effective tariffs have not been, when people get into details, there's so many exemptions, there's so many special deals and so on. The effective tariff is well below the headline. So, if you do a first pass analysis, you stick in the headline numbers, you are going to overstate before you do the more detailed analysis. But actually, I would say the economics profession, both public sector and private sector, have done an impressive job in analysing tariffs over the last year and a half. And it's been really impressive, I think, data hunting to find, okay, why exactly has it not looked so strong? I think the answer is that's because tariffs have not been as big as expected, and then lags. We have not yet seen everything. So I think it's an ongoing issue. And then we come back to, again, maybe fundamentally for us, we do say meeting by meeting data dependent, because there's a lot of rich data coming in every week, every month. So we really don't want to say, here's our fixed view that's invariant about how tariffs work. Here's our fixed view that's invariant about how Chinese export deflation works. And it's you really, we have a few hundred people at the ECB, more so in the Euro system, amazing research economists, really digging at everything. I think the economics of a private sector institution is, you don't have the scale that we have in terms of the amount of research that we can do. And it's really, I think this kind of analysis-led data dependence approach is so important.
No, that's true. I think one of the things that we can see perhaps at the same time as you or earlier than you is when there are some waves on financial markets or liquidity dislocation. We were discussing this when you arrived, and this brings a question to me, private credit, which I guess is in the financial stability report you published this morning. It's getting through a lot of investment that we are seeing, really a lot, especially as a lot of financial sponsors now are backed by insurance companies. So there's obviously the question that a lot of them are US driven and invest in Europe. So in the grand scheme of strategic autonomy, and this can be one issue. But there's also the question that they're obviously not regulated as we the banks are. So I was wondering how you're looking at this. What would be the variables that would raise your concern, or the one that you would be monitoring more particularly when it comes to the effect on financial market and banks?
So clearly there's a lot of focus on this question. And maybe the first thing to say from a European perspective is, for now, it remains dominantly an issue for the US financial system. There's, as you said, there's certainly activity in Europe, absolutely, both in terms of the same US firms trying to kind of expand their activity, roll out the same approach here in Europe, but also European firms saying, what can I pick up? Because there is some, technological advances, if you like, in having a degree of a role for private credit firms, private equity firms. Again, partly by design. You may have noticed over the last 15 years, the amount of regulation of banks has gone up. And fundamentally, banks are different. A very big reason why banks are heavily regulated is they are deposit takers. Deposits are very important in the payment system. Deposits also come from hundreds of millions of households who cannot be expected to monitor the financial institution in the same way as an institutional investor. So banks are different. The risk-taking that we can tolerate in a private credit firm is different to the risk-taking we would tolerate from a bank. But, and we had this at Sintra, our annual conference, and again, if you're not looking, we tend to get these amazing studies at Sintra, and we had one this year about the interlinkages. So one basic thing we're monitoring is, of course, behind lots of private credit firms is a line of credit with a bank or some kind of standby arrangement. So in terms of looking at liquidity, leverage, and so on, there's a lot of interconnections with the banking system. So one is any spillback to the banking system, and two, of course, is essentially financial market valuations. If financial market valuations basically are kind of, any shock is amplified by any downturn in private credit and private equity, then that's clearly a transmission mechanism we would have to look at. But what I would say is a lot of this is in the US for now, but we clearly, and also, as you mentioned, the kind of interconnection with the insurance industry is something we look at as well. So I think, maybe to repeat myself, full-scale analysis, of course there's a lack of data, but in terms of scale, it's not at the same scale yet in the European context as in the American context.
Thanks. There's someone right in the middle who I can see. That will be the last question, unless, Antonio, you want to ask a last one.
Okay, maybe then to wrap it up, everybody's now thinking about...
Can you stand up? So,
yeah.
Thanks.
Dr. Lane, thank you for your valuable comments. Everybody's now thinking about a 2026 outlook, where rates will be sitting. And so the natural question, and I think going back to the AI story, would you agree that there is a natural downward bias for both Fed funds and maybe the ECB repo rate on the back of AI? Because if things don't go well, all these massive investments, all these wealth effects on the back of the rally of the NASDAQ, NVIDIA likes, would be unwound. And if you look at the weight of growth in the US in terms of investments, more than 50% is already AI related. So maybe the Fed will have to respond to that, cutting rates. But if things go well and AI really does it, until productivity gains are very visible, the first effect would be probably massive layoffs. And therefore, the Fed will need to react. So I don't know. I know Europe is lagging behind. But would you agree that maybe the bias is more towards lower rates as we move into 2026? Thank you.
So let me rephrase your question so I don't have to answer it. Because it's a kind of expansion of the question we had already. So in the question we had already, what I said was, in terms of the kind of trend scenario where AI trend is clear, and that trend scenario does have a prolonged investment phase, because essentially AI is a function of computing power in the end. On the other hand, because of the labour market issue you have, then you do have the precautionary savings issue. Is, will people fearful for the future save a lot? The way I would describe it, those are two trend factors, and there's a contest, between the saving and investment side of that. Then you get to the business cycle context, and I would say there's two business cycle contexts. One is people who are all in on AI, and I invite you to read Nouriel Roubini's op-ed in the FT from yesterday, if you want the all in on AI narrative. And that should mean stronger cyclical consumption. People who believe the future is so bright may start to consume more. But you give the opposite one, is what if AI is disappointing? What if we do have essentially the bubble bursting, if you like, and a big hit to demand? So I would say the cyclical risk is two-sided, the trend risk is two-sided, and therefore perfectly I don't have any information to give you on 2026 interest rates.
I think it's the perfect conclusion. Thank you very much, Philippe, and thanks for the question.
Thank you.
Thank you.
Thank you. Thank you, Philip.
So we are going to do a bit of a ballet with change of seats. with Philippe and Antonio leaving us and giving their mic to Sylvie and Florence. And while everyone is getting seated,